succeed eventually through daily discipline and structured training. Likewise, when you are planning for your retirement, I always say that retirement success is less about earning huge salaries and more about consistency in saving and investing. Someone who contributes steadily to a pension scheme over 20, 25, 20, 30 years often retires more comfortably than someone who earns well but saves inconsistently. Three, I always say that preparation needs to begin early. When you look at the elite runners, they start training years before competing on the global stage. So you will find them in Eldoret, you will find them, even here in Nairobi, training way before they get to the global stage where they win. So retirement planning also rewards early starters, and it rewards people who start preparing early because of the compounding aspects of the returns and the contributions as well, which we shall be talking about. But then I'll give an example. A person who starts saving at the age of 25 generally accumulates significantly more wealth than someone who starts saving at 45, even if this person who starts saving at 45 will be contributing aggressively. When you look at the marathon runners again, you will see that they rely so much on coaches, so much on they have support system, they have physiotherapists, they have structures which matter. They rely on nutritionists and also all these people. And in retirement planning, you also need to rely on financial advisors, pension schemes, investment managers. You need to rely on trustees so that you can be able to win. For you, we always say that very few people are able to retire comfortably when they plan on themselves or by themselves. Five, we say that we need to be able to manage risks. And when you look at what our marathon runners do, they always know what time to conserve energy. They always know what time to accelerate and when to adapt to new weather and terrain. And as a result, I compare these to retirement planning, whereby we require risk planning, risk management, diversification, and adjusting investment strategy with age, depending on our age, basically to prepare for economic uncertainties, which we have seen happening in the last few years. Young savers may take growth-oriented investments, while those nearing retirement may shift towards capital preservation and guaranteed income solutions, so that they are able to get better returns. And lastly, my last comparison to our marathon, phenomenon is the goal is to have sustainable performance across the years. When athletes train, they don't just start strong, but to finish strong. Yeah. So retirement planning is ultimately about maintaining dignity, independence, and financial stability after active working years. And a good retirement plan ensures that after the race of employment and business life, individuals can still afford healthcare. You can still afford to maintain your lifestyle. You can still afford to support your dependents. We are seeing cases of, retirees supporting their dependents and their children and, great grandchildren. And above all, to be able to live with peace of mind. So what lessons do we get, or rather the lessons that we get from the Kenyan athletes is that success is not built in a single day. It is built through discipline, endurance, preparation, and consistency. And I liken this to retirement planning, which follows the same principle. So the earlier we start, the more disciplined we remain, the better pace, the better we pace our financial discipline and ourselves financially, the stronger and more secure our lives become at the end of the day when we finally retire. So I will ask a question, and I will ask a question, and I will appreciate maybe to see some action on the chat. What do you think is retirement, according to you? What do you reckon is retirement? And I will pause to have a feel of one or two answers from the audience. Okay. In the interest of time, maybe I can define what I feel is retirement. And I will read or basically tell you what is retirement. According to the Cambridge Dictionary, they say that retirement is defined as the point at which someone stops working, usually because of reaching a particular age or due to ill health. It also refers to the period of life after a person has stopped working. Yeah. So we can define retirement in so many ways. Right now, the majority of the young people, including myself and the people I work with, usually say that we would like to retire early and not because of age. I would like to travel probably by the time I get to mid 40s. I would like to enjoy my life and do other things. So, in essence, by that time, I should have, prepared myself accordingly and be able to leave employment. Stop earning my employer benefits and be able to continue life out there. So either I will do that because I will be in business or I will have saved or invested enough to continue earning an income. So we ordinarily are employed from around the age of 25, and we normally retire at around the age of 65. That gives us basically 40 years of active working life. And 40 years basically cumulates to about 480 months. When you look at the 40 years, sometimes you want to tell yourself that it's a very long time. But then when you translate these into the months and the salaries that you will probably be earning, then that number becomes, realistic. And 480 months, it's not such a long time. We have seen many of our retirees who retire at around the age of 65, live all the way up to around an average age of 90 years, which basically gives us about 25 years in retirement. That's about 300 months. So a question that I always ask myself is, and I always ask the customers and the people that I meet is that right now we are quite active. We are earning a very good income. We are getting side hustles left, right. We have the energy to be able to earn an income today. But have you started putting your retirement together in this active phase of life so that you can be able to utilize that retirement plan so that in the retirement age or in the retirement phase of life? And I always like to encourage the people I meet or the customers I meet to be able to utilize this active phase to be able to build a solid retirement kitty and invest as well so that they can be able to retire well. A bit of statistics, something that has been going on in the market. They say that 86% of us are headed for poverty in retirement. This is attributed to basically the fact that we do not save or sufficient, we do not invest sufficiently. Only 1 in 7 Kenyans are confident about their retirement. Basically, so if we are 100 people, you can do quick math. And yet, a good number of us, roughly 20% of the Kenyan population, is actively contributing for their retirement savings. And this is mostly people within the formal sector. And many of us are actually participating under the NSSF act, which is mandatory. So when you look at the majority of Kenyans, then you ask yourself, what is going on? So what this translates to is that when people reach the retirement age, or when we reach the retirement age of about 65, 47% of us will be dependent on relatives. So there is a saying by the older generations that, when my grandfather was taking my father to school, he was doing that so that my father could be able to take care of him in his old age. So, and this narrative has been there, of course, because as Africans, we have that, social responsibility to give back to our society. But then the question comes in, and this question, I'll throw it out there to the audience. Do you think that your children, the children that you are taking to international schools, the best schools, and you're giving them the best of education today, do you think those children will be able to take care of you when you finally retire? Yeah. For me, when I look at my children, I think not. And it then begs the question, what do I do? Yeah. So the only way out is for me, as much as I'm taking care of them, I also need to take care of my retirement so that I do not fall in this category of 47%. They say that 31% of Kenyans who retire at the age of 65 continue working, and we will see proof in our next slides. We have seen scenarios whereby people leave employment and tomorrow they still come back to the office, and in the coming months after retirement, they still come back to the office to look for a contract or to be able to look for an income so that they can be able to manage their day-to-day expenses. 16% of Kenyans who leave work, they are dependent on state pension. That's NSSF and Pesa ya Wazee, which to an extent, of course, it is money, but it's not sufficient to warrant, a comfortable life at retirement. And only 6% become financially independent. Yeah. So still, on matter statistics, RBA did a survey some time back, and they actually posted the findings of this survey, and they say that the most common utilization of lump sum payments. So for those people who are in a provident fund or are in a pension fund and they receive their 1/3 retirement fund, what they usually do with this money is most of these people utilize their benefit to construct or purchase houses to live in. And this is followed closely by paying children's school fees. So when you look at that, it basically means that when we are not adequately, planning for our retirement, because by the time you get to the age of retirement and that is the time you are still, buying a house or constructing a house, then it speaks volumes that we are not, we've not planned adequately. 75.1% of retirees report receiving a monthly pension of below 30,000. And only 1.9, that's about 2%, receive a monthly pension of about 100,000. Another finding was that school fees and loan repayments top retirees' monthly expenses. So we will need to speak about this because as we are planning for our retirement, then you need to be able to pay off your debts way before you get to the retirement date, such that when you start earning your annuity or your pension, then you do not use that pension to pay your loans. On school fees, it is understandable sometimes, but then you can also work backwards and be able to sort that challenge. Retirees report a growing number of their children who are aged 18 and above, being still dependent on them. And this is, of course, something that is actually taking a lot of toll, or rather taking toll on people, and something that we need to address. Of course, we have the Gen Z factor, where people don't want, they get employed, and tomorrow they can tell you, my dad or my mom is well off, so I don't necessarily need you to employ me any longer. But we need to address, these are situations that needs to address. Otherwise, we see a possibility of this getting out of hand. Where retirees report grandchildren as their dependents, the highest concentration is on those aged between 6 and 11 years. This speaks volumes as well to how our children are taking, on their responsibilities of adulthood, and something that as parents, we need to address. What would these retirees do differently? Would have done differently in their active age? 50% say they would have increased their savings on additional voluntary contributions. Of course, 92% said they wish they would have started a side hustle early, and this side hustle would have, given them more income to be able to save for their retirement. 22% say they wish they would have sat down to plan for their retirement early enough. 63% say they wish they would have started a post-retirement medical fund. And of course, we will be talking about this post-retirement medical fund later on. And then 99%, which is basically 100% of us, say they wish they would have participated in scheme events like AGMs, member education forums. These are very, very important forums that help us to understand how our retirement benefit works, how our scheme is being managed, and the returns that we are getting from our fund. So because of that, I've already given, reasons as to why we need to start planning early. And one, I think, when you are in your active stage of life, you are very healthy, you are very, you are taking care of yourself. Nowadays, I see people running. Nowadays, I see people, researching about health, going on diet and so forth. However, with old age, you have unforeseen medical expenses, which basically will require a lot of money for you to be able to sustain that. And as a result, we need to be able to plan for our retirement quite early. And go a step further. Not only do you want to plan on your retirement using finances only, you also want to plan your lifestyle around your retirement. So you want to be able to be healthy today so that you will be healthy in the future. You want to take care of your family today so that they can be able to take care of you in the future and have a support system, when you finally retire, because that's the time that you'll be able to need your family and your support system. You want to be able to save on plan for your retirement quite early so that you can be able to safeguard your financial independence. You don't want to be dependent on government. You don't want to be dependent on people and, community and society to be able to take care of you. There is a living standard that we are used to while we are working, while we are, in our active phase. Today, you ask me, once in a while, I would like to go on holiday. Once in a while, I would like to go out, take my family out. And that is as a result, that is because of the perks that I earn, that I get from the job that I do or my side hustle and so forth. So in the event that I retire and I do not have sufficient funds, then basically I would not be able to maintain that standard of living. I would not be able to go on holiday. I would not be able to, enjoy those little pleasures of life. So for us to be able to maintain that standard, I will need to be able to save sufficiently, to invest wisely and prudently, so that in future I can be able to utilize that money for a good future. Retirement benefit schemes, of course, come on board with tax benefits. and returns as you save. So my colleague Martin will be taking us through that in the later phase of this webinar. And lastly, I think for me is peace of mind. I value peace of mind, and I trust that my audience also does value their peace of mind at retirement. When you finally retire, you do not want to, be bothered about things like inflation. The money that you have is not sufficient to pay for your bills or for your healthcare. So you want that peace of mind when you finally retire. And that can only be achieved from the investments that you do today when you are still very active. So mentioned earlier that we have seen scenarios whereby retirees, are heading back to work amid high inflation. I'll give you an example. In a job I was in before, in a company I've ever worked for, I had this colleague. I'll call him Mr. Mutua, of course, not real name. So Mr. Mutua retired at the age of 65. And when he retired, that was way back in 2017. We did a very good party for him. I almost used the Gen Z word bash. We did a very good party for him, and we gave him quite very good gifts. Of course, as an employee of that company, and I've always worked for an insurance companies, he had, of course, a very good pension package. But he went home, and then a month later, we started seeing Mr. Mutua back in the office. So Mutua used to come very early in the morning, putting on a suit, tie, say hi to us, hang around the office. And whenever any of us had a small errand to run, he could actually ask us to give him those errands so that we pay him. Later on, I interrogated further what happened, and I thought he had a very good annuity. And Mutua told me that the annuity he was earning was actually not sufficient to cover his costs. So as a result, he opted to come to the company that I used to work for, so that he could get those errands, so that he could get money to sustain his day-to-day needs. And this was because of inflation. So I know the young people are saying that we don't have jobs, but the old people are also coming back to the workplace and saying, look, I have experience of this kind of work that you do, so I also need this job, and they can do it better than the young people. So this is quite unfortunate. For us, we need to be able to look at this inflation situation from the get-go in our active phase of life right now that we are saving for retirement. So what do we need to do? We need to be able to put in money. We need to look at the returns that our fund is earning. And these returns should be above the inflation rate. Basically, it should be able to give us our value for money now and into the future. We've also seen articles about retirees' hidden burden, where retirees are forced to spend their pension on children and grandchildren because of lack of income. So this basically is a very huge sign that we need to be able to save and invest prudently, and the earlier we start, the better. Yeah. So what will you do for you to be able to start planning your retirement much earlier? And for me, when I look at this, I always tell myself, I always imagine what kind of lifestyle would I like to lead when I finally reach that retirement age? And that lifestyle, I start building on it today or as soon as possible. What kind of hobbies do you intend to take up? If you would intend to take up golf, of course, and things like that, very active hobbies, so that you are physically active. Look at those hobbies. What kind of relationships would you like to maintain, and how do you want to maintain those relationships? So this is actually one of the biggest determinant on how you will live in your retirement. And the moment you figure out these you get a picture of what your retirement will look like, then you can start building on your financial aspect around it. Yeah. So as soon as you figure that out, then you'll be able to know how much money will you require in terms of expenses at retirement, how much cash flows would you be having, yeah, from your, properties, rentals, from your bonds, from your annuity, and all these cash flows will then be able to give you or allow you to be able to live the kind of lifestyle that you anticipated from the get-go. Yeah. That then trickles down and gives you, or rather comes back to an aspect we always call, we call income replacement ratio in our industry. So this is the level of income that you would want to earn so that you can be able to sustain the lifestyle that you dream of. And professionals in our industry estimate that one requires about roughly between 60 to 70% of your final paycheck every other month after that for the rest of your retirement age, to be able to live, for you to be able to live comfortably with peace of mind, and for you to be able to actualize the lifestyle that you had anticipated from the get-go. And we assume, or rather we take this assumption takes into consideration the fact that by the time you retire, you will not be commuting to work, to and fro to work. You will have reduced on some expenses, some entertainment costs because of old age as well. And as a result, you'll be able to live comfortably with about 70%. So I'll give an example. If my final salary will be 100,000 shillings, then I require about 70,000 shillings every month thereafter to be able to live comfortably. Of course, as a retirement benefit professional, I would want you to put most of your money or all of your money in a retirement benefit scheme. But I always tell people that you do not have to have only the pension scheme that you have as your only investment towards your retirement. There are many other, investment avenues out here which give you good returns as well. So it's a matter of balance. You can be able to balance your investments, play with the treasury bills, treasury bonds, which are long-term. You can be able to stagger these maturities so that you get a good return at the end of the day. You can be able to invest in equities. And I think right now, technology has actually helped us to be able to invest in the equity market and divest from the equity market as fast and as quickly as you require. You can be able to participate in mutual funds, money market funds, for liquidity, for you to be able to have, an emergency fund. You can be able to put your money in a money market fund. And CIC has a very good money market fund, which we will be able to interest you to partake in or to try out. And one other thing that I always tell people is insurance. I look at life from a different perspective. I'm able to provide food, shelter, clothing for my family and for myself because of the income that I earn. Yeah, because I am healthy, because I'm physically and physically active, and I'm properly, my body is properly functioning. But then I always ask myself, what if there is a day that I will not be able to continue working to be able to earn an income? So in that eventuality, then I need to have an insurance policy that will complement or that will be able to take care of the basic needs, the food, clothing, and shelter for me and my family. until I regain the capacity to be able to continue earning the income, I need that insurance policy. So I always encourage people to be able to take or get other life insurance policies so that you can be able to complement your life. You can be able to mitigate that risk factor, that there's a time also you'll not be there, because we are not mortal beings. So these will be able to take care of your family. And at the end of the day, some life insurance policies actually do supplement your retirement income at the end of the day, because when they mature and you are still alive, you'll get a payout. And I welcome you to be able to see or find out what CIC Life has. We have very good life insurance covers. We have very good education policies and very good whole life and endowment policies that will be able to give you that backup. And then you need to be able to determine your current savings habits, your current expenses habits, and these will be able to help you save and invest and plan wisely for your retirement. So when I look at my retirement, I want to be able to also look at which scheme or which investments are tax efficient for me. We always say that I need to put in additional voluntary contributions, so that because of the tax efficiency nature of it, many people are still contributing for their retirement, but they have not maxed out on the tax efficiency in their scheme. So you need to look at that. The additional voluntary contributions will help boost your retirement income, and they are also portable. You can transfer them to your new employer if you move jobs. They are flexible. You can vary, you can stop, you can start at any given time. I'll give a saving scenario as I finish my presentation and invite my colleague. So I'll give a saving scenario. I need to be able to have 3.5 million shillings by the time I reach the retirement age. Assuming I have 40 years to get to the age of 65, basically age 25, I only need to put in 550 shillings every month so that I achieve this 3.5 million goal. If I have a shorter period to retirement, say I have 5 years, I then need to put in much more. That's about 44,000 shillings so that I achieve the 3.5 million. So this takes us back to the conversation that we had. The earlier you begin saving or investing for your retirement, the better, because then you put in less and you let the compounding interest aspect take care of the rest in your retirement. As I finalize, remember that your plan does not have to be static. You can review your plan periodically, adjust your plan based on salary adjustments, promotions, job changes, significant life events. We've seen people who are in retirement benefit schemes. Whenever they leave their jobs, they come and cash out their funds and utilize those funds to pay debts and so forth. But then you do not necessarily have to cash out, but keep on building on your retirement plan, and you shall turn out well in retirement. So at this juncture, allow me to introduce Martin to take up the next phase of this webinar. Thank you very much. Martin, over to
you. Thank you, Vincent. Hopefully you can hear me. Maybe Vincent, you can pull out your presentation.
Loud and clear, Martin. Proceed. Okay.
Vincent, you can confirm to me whether you can see my screen.
Yes, proceed.
Okay. Good morning, everyone. My name is Martin Mwangi. We'll be taking you through the retirement benefit options, as mentioned by my colleague Vincent Ochoi, and going by our theme, of today, which is work hard today, rest easy tomorrow, just to show the platforms, the solutions that we have for you, so that we're able to retire comfortably. I'll just jump straight because of time, just to mention the types of schemes that we manage under CAC Life, and I'll highlight on the CAC umbrella scheme, occupational schemes. We have also individual pension plan called CAC Jipange Personal Pension Scheme. And also just to mention, we also do deposit administration where we invest funds for different schemes. We have CAC umbrella. We have two schemes which have been registered with RBA. We do it on the benefit, especially when it comes, which is very costly, especially to register a scheme. So what we have done as CAC Life, we have registered two schemes, the CAC umbrella and CAC Jipange, where an individual can join an individual pension plan. They can be doing monthly contribution, and also an employer can also join our umbrella scheme where they can be doing NSSF contributions. They can also be doing what we call tier 3 contributions way above the statutory deductions. We also have occupational schemes where we do both administration and fund management, and as mentioned, the deposit administration where we do purely investment. These schemes, their defined contribution, what it means is that a member is supposed to contribute, and maybe in some cases, especially in umbrella scheme, occupational scheme, where both employee and employer contribute. And they can be either pension fund and provident fund. And especially this is what we'll tackle today, especially in the retirement options, where we have an annuity and an income drawdown. And you find in a pension fund upon retirement, the difference comes in upon retirement, where in a pension fund, you find you cannot access cash lump sum. You can only access 1/3, 2/3 you have to purchase an annuity. But in a provident fund, you can access 100%, or you can access a portion. Then the balance you can purchase an annuity or an income drawdown. And just to mention that the kind of investment that we provide, the investment vehicle that we have under CAC Life is, we call it a guaranteed fund. We have two types of investment vehicles, that is the guaranteed and segregated fund. But for this case, under CAC Life, we do guaranteed fund. And it has the following features. One, it guards against capital impairment. We protect the principal and the contributions that you do. So at no any point, we usually say you have a minimum guarantee of 5%, which is guaranteed. And at no any point, you're able to lose your principal and your contributions, because at any point you are guaranteed of a minimum return of 5%. Also, this since it's a pool fund, this provides liquidity, ease of benefit settlement, to be able to pay benefits within 5 working days. We also, the CAC Life bears the investment risk. If you compare to segregated funds where the member bears the investment risk, but for this case, under guaranteed fund, we CAC Life, we bear the investment risk. You also get to enjoy benefit of economies of scale. That's able to see the returns that we declare, and then when you remove the expenses, you find you get a good net return. Unlike where where it's just one scheme, you find you get to bear more of expenses and such. And also just to mention that on average, the returns that we have declared over time, on average return has been around 10.5, which is above also the inflation rates. If you compare the inflation rates, also if you consider the industry average, the rates that have been declared over time, says CAC Life has performed quite well. You are above the industry average if you compare the average returns declared by our peers. But just to show you that we guarantee you that when you invest also, and when you plan for retirement with CAC Life, you're able to retire comfortably when that time comes. And just to mention on the benefits of why you need also, especially to save in a retirement scheme. There's also tax benefits that have been there, that are there in the Income Tax Act. Just to mention that every month you get to enjoy 30,000 per month. That is a tax deductible amount. So, for example, if you have a salary of 100,000 and you're doing 30,000, only 70,000 is being taxed. So it reduces your pay. And like, for example, if you're not doing any pension contribution, and it's only 100,000 that is being taxed, so you get to pay a higher pay compared if you're doing pension contributions to the scheme. And that's why we encourage, especially members, if you're able to take advantage of also of to boost your retirement pot by doing additional voluntary contributions, so that you get to enjoy the tax deductible of 30,000. Also, there's also other benefits, especially for people who have gratuity. instead of waiting for 5 years or maybe after the contract expiry, then it's calculated. Then you get to be paid those benefits, and there's no interest. And we also recommend that those gratuity, they can be done monthly. Then they can be done through our umbrella, through our individual pension plan, where you get to enjoy the same benefit, tax deductible of 30,000. These benefits get to earn interest, and after the contract expiry, you get your benefits plus also the interest earned for that period. And also the other benefit, just to mention, especially when it comes to gratuity, you find that in case you get dismissed before the contract expiry, you get to lose those benefits. But while in the pension scheme, you don't get to lose those benefits. So you can resign, you can get terminated, you can get dismissed, but you still access your gratuity benefits. Also, just also to highlight on the post-retirement medical fund, especially now, we're in an era where you find people retire, but the funds they get after retirement, most of the biggest percentage goes to medical expenses. But now, currently, just to mention is that our scheme, that is the CC Umbrella and Life and the CC Jipange, you're able to save for post-retirement medical fund. You get to enjoy a tax deductible of 15,000 per month, and it's a benefit because these funds, they're supposed to take care of you instead of now the monthly pension that you're getting, or maybe the lump sum that you get. That's what you lose to purchase maybe to pay for medical expenses. You save for under post-retirement medical fund, just the way you do the additional voluntary contributions, the way you do the NSSF, the way you do the other contributions, maybe employer, you do a top up, which is voluntary. Then it will take care of you when you retire. You find that you'll have some monies you can either use to purchase an annuity where it's being channeled to a provider where you purchase a medical cover, or you can put it as a lump sum where you can be drawing down based on the medical expenses. This is just to highlight the benefits that you get to enjoy saving in a pension scheme. As mentioned, tax deductible of 30,000. If you're doing pension, when you're doing gratuity, also 30,000 per month, which is 60,000 per annum. Also, when it comes to post-retirement medical fund, that is 15,000 per month, 180,000 per annum. So just to mention is that, assuming that you're doing both, let's say voluntary, or you're doing pension contributions and post-retirement medical fund, and you're getting a salary of 100,000, that means only around 55,000 gets to be taxed. So you save on pay, and also when you retire comfortably. You have funds to take care of you, and also you have funds in case of any medical emergency. You're able to take care of that. And also and also, as I mentioned, because sometimes people ask, what are the benefits that I get to enjoy when they save in pension scheme? The other scenarios also, just to mention, is that assuming someone retires under ill health retirement, they don't get to be taxed. Also, assuming you save in a pension scheme, assuming you joined at the age of 25, you at the age of 45, you are saving the pension scheme for at least 20 years, you don't get to be taxed. And also, as mentioned, in case you access benefits above the age of 50, before you could only get tax-free benefits if you're at the age of 65. It was revised in December 2024. Now, as long as you're at the age above 50, you're able to access your benefits tax-free. So this is just to encourage members, instead of cashing in, and especially when you leave employment, just to encourage your peers, your friends, instead of accessing those benefits, kindly transfer to a pension scheme. CC Jipange we have, you transfer your benefits. You don't get to access at the age of continuous earn interest. At the age of 50, you can access those benefits tax-free. Because if you access when you're below 50 years, you get to pay a higher tax, because which also reduces the benefits at the point of retirement. And also, maybe just to mention is that the funds, the current schemes that we have, that is CAC Umbrella and CAC Jipange, just to mention, these schemes have already been approved to manage the NSSF Tier 2 contributions. So especially for those who have, NSSF Tier 2 contributions are going to NSSF, just to encourage those employees, those members, is that you can contract out to our umbrella scheme and our IPP, so that at least you're able to enjoy the returns that you have declared over time. Also, ease of accessibility. We also have digital platforms, so you're able to monitor your contributions every month. You're also able to attend AGM, so you're able to get to review the performance and also to understand the scheme activity for the full year. So just to encourage, especially for those NSSF Tier 2 contributions that are going to NSSF, kindly challenge them to our umbrella or to our individual pension plan, where you're able to monitor, where in case you retire, ease of accessibility is easier. You also get to enjoy the good returns that you have declared over time, and also you're able to enjoy the minimum guarantee of 5%. This is just to show you currently where we are. Currently, the tier 1 is around 540. employer matches, just to confirm that once you do the contributions, also the employer matches. The tier 2 contribution, you can see it's way higher, especially for someone who is earning above 108,000. This is the current ceiling, above 108,000, where you can see employees doing 5940, employer 5940. So these are around 11,180, and tier 1 is around 1,080. So tier 1 is supposed to go to NSSF. Tier 2, you can transfer to a pension scheme. Like now, as I mentioned, the CCA umbrella and individual pension plan have already been approved. I'll just show you the 2 certificates just to confirm you're among the first insurance companies or among the first administrators and fund managers to get approved. That was in May 2023. This act came into effect in 2023 February, and 3 months down the line, we already approved. This just to show you the confidence also that the industry has with CIC, and also just to confirm that we're able to assist you in that process of contracting out. You don't have to worry on how to go about it, on about documentation. So you have all those documentation. So we just guide you on what needs to be signed, what needs to be filled. You share with us, we do that application on your behalf. We follow up to ensure that it has been approved, and then you can start now making those contributions. And just also to mention, because people might ask, do NSF contributions get to enjoy the same rate with my voluntary contributions? Do they get to enjoy the same rate with the other contributions that my employee and an employee is doing? They get to enjoy the minimum guarantee. They also get to enjoy the good returns that we declare annually. So you don't have to worry whether they'll be treated special. It's only that in your benefit statement, you'll be able to see what is NSSF, what is additional voluntary contributions, and what is employee and employer contribution. And also just to mention is on the retirement options. After you have done the voluntary contributions, you have done PRM, post-retirement medical fund, you have done the NSF contributions, you have done you have top up, you have sacrificed. At retirement, especially if you're in a provident fund, the law allows you to access 100%. But we just we usually advise the members is that you don't have to access 100% if you don't need the 100%. You can access a portion of it, then you can convert it to an annuity or an income drawdown. But if in a pension fund, the law allows you to access up to a maximum of 1/3. So it can be a lower, but up to a maximum of 1/3. Then to that, you can purchase an annuity or an income drawdown from any insurance company. And as a member, they have a choice to select which insurance company. And just to mention is that the difference between an annuity and an income drawdown, an annuity guarantees you income for life. At no any point you'll have to worry about investment return. Maybe Iran war, you have to worry maybe the election, what will be my monthly income. You don't have to worry about that, because if you're guaranteed over a monthly pension of around 30,000 shillings, that's what you'll get for the next 30 years, 40 years, as long as you're alive. But in an income drawdown, the law allows you to access up to a maximum of 12%. So what it means is that, for example, if you have 1 billion, you're purchasing an income drawdown with 1 billion, you can only access 12% per annum. That is around 120,000 per year. Then it's divided. You can decide whether it's monthly, quarterly, semi-annually, or annually. So you just divide based with your need, but it has to be a maximum of 12%. So if, for example, you're drawing down 12%, and the average return is 10%, that means you're drawing down more with 2%. So we usually say, if, for example, you don't have any other source of income, take an annuity. But if you have other sources of income where at least you don't have to worry about the market, what is happening in the global market, whether there is any geopolitical tensions, you can take both an annuity or income drawdown. So it's not a must that you have to take either. You can take both. Sometimes you might find someone has maybe 10 million or 20 million. They want to diversify. You can take maybe if you have 20 million, you can take 10 million in an annuity, 10 million in income drawdown. But what we usually say, if you don't have any other source of income and you don't have to worry, annuity is the best product where at least you're guaranteed of income. And usually say, just do a simple simulation is that, if, for example, you have 5 million, just do 1% of 5 million, that's around 50,000. It tells you on average how much you'll be able to get. But based on the age, based on also the guaranteed period that you'll choose, and also based on the escalation, and also based on the gender, the annuity amount varies. And it's just to show you on, for example, this is a client, it's a male, you find they had 5 million. On average, they'll be getting pension of around 50,000. But based on the guaranteed period, the longer the guaranteed period, the lower the monthly pension. With zero guarantee, you get a higher pension compared to a guarantee of 20 years. And also, if you compare with a joint reversion of 50 and 100%, reversion means is that, for example, let's say as a principal member, today you die, or maybe you die, you're supposed to continue to get the same pension, whether it's 50% or 100%. If it's 50%, you can see the pension tends to be lower. If it's 100%, it tends to be low. But what it means is that you're supposed to continue to get the same monthly pension. If it's 50%, they get 50% of what you are getting as a principal member. If it's 100% reversion, they're supposed to continue to get the same pension that you are getting. And also, just to mention is that men or maybe male tends to get a higher pension compared to female, because it has been, research has proven that men tend to live a dangerous life. Maybe they tend not to live long compared to women after retirement. So you find the monthly pension is a bit higher, but not with a huge variance, maybe around 1,000 shillings. Because if you compare a male at 20 years, it's 48,195, and a female at 47,444. But it just tells you and how it works. So especially when you want maybe to get how much you're able to get as a monthly pension, what you only need to provide is the date of birth, the purchase price that you want to purchase an annuity with, and also the gender. Then you're able to give you an annuity quote. For income drawdown, the age doesn't matter, the gender doesn't matter. It's only the amount that matters, because it's based on the market performance. And also, just to mention is that after 10 years in an income drawdown, you can access the balance, or you can continue the income drawdown, or you can purchase an annuity with the balance. This is just to show an illustration of an income drawdown on how it looks like. Is that if, for example, let's say the law allows you to take 12%, and then the average performance is around 10%, you find after 10 years, you'll have a balance of 4 million compared to a balance of 5 million if you're doing down based on market performance. So usually advise the client is that, for example, if you're taking an income drawdown based on the market performance. If, for example, in year one, the performance was 10, it's 10%, draw down 10% for that year, so that you're able to protect the principal. If in year two, the performance is 8%, take 8%. So the reason why usually it comes, so that at least you're able to protect the principal, because sometimes as you age, you need more money. And like now when you are starting your retirement journey. So we recommend at least to take advantage of that, just to monitor market performance. And that's why sometimes we recommend an annuity, because you don't have to worry whether tomorrow there'll be war, whether tomorrow the interest rates will change and such. Because an annuity, as long as it's 30,000, you're guaranteed over 30,000 for the rest of your life. So just members, just to encourage, even as we save, I know sometimes we find cases where someone says, it's my money, I know how best to use the funds. But you have seen cases where people retire with good money, 10 million, 20 million. After 2 years down the line, they don't have anything. But if you compare someone who had less than 5 million and they purchase an annuity, they get to retire comfortably. Because I'll post this question: assuming today you have 5 million, it has been credited to your account, and your brother or your sister has a kid, or maybe you have a nephew, or you have someone who you take care of, and for example, they need 100,000 per month, 100,000 maybe to pay for their school fees. How much would you give them? Most likely, looking back, that you have 5 million in your account, you'll give them the 100,000, because you'll be like, if it's 5 million, you'll only be left with 4.9. 4.9, I'm able to do 1-2, and then maybe I can get another 5 million. And sometimes that's the time you find, me, for example, you're going to Harambes, you're being invited, maybe like now there's rain, maybe the school that you are going to, maybe the toilet has collapsed and such. So sometimes now you're invited as a guest, and sometimes you find, for example, because you'll be like, now, let me support this school because I'm an alumni. And if, for example, let's say they need 5 million, maybe they need 1 million, then you contribute 300,000, then you're left with another maybe 4.6. But assuming the 5 million converted to an annuity, you're getting 50,000. And now your kid, someone you love, someone you take care of, maybe they have a fee balance of 50,000 or 100,000. How much would you give them? I can tell you for sure you'll not give them maybe even more than 10,000, because you'll be like, if I give them 50,000 or the entire balance, I'll have nothing to live for the next maybe 1 month. So it tells you about the decisions that we make after retirement. Sometimes it's the choices that we make after retirement. Sometimes we find it's not like we don't have money, but it's the choices that we make at retirement. So just to encourage members, just to, even if you have the cash, just take what you need, then the balance convert it to an annuity, so that at least in case there's a miscalculation that you do after retirement, you have a fallback where you have a monthly pension and you can rebuild again. So it's just to encourage members, even after retirement, you have a choice and a decision to make on the best options at retirement. And also, just to mention on the post-retirement medical fund, we have seen cases where people, they retire, most of their funds, they have the 10 million, the 5 million, is being used to take care of medical expenses. But with the current schemes that we have under CC umbrella, CC Jipang, you're just encouraging members. Apart from the voluntary contribution, the NSSF, you can also save for the post-retirement medical fund. You do an additional voluntary contribution, you get to enjoy a tax deductible 15,000, and then you build up a pension. And at retirement, you can either decide these funds can be drawn down every year to pay a premium for medical cover, or it can be drawn down based on the medical expenses, so that at least you're not able to touch your pension funds, where you find, for example, you're using your monthly pension to take care of your medical expenses. So this is just to encourage members. We have solutions for you so that you're able to save for retirement, also to save also for your medical cover, because when you exit your employer, or you don't have a medical cover, you don't have a salary. So just to caution you, so that at least you're able to save and also to protect yourself at retirement. And so just to mention who can contribute, it's a member, a sponsor. Sometimes you find even an employee is willing to contribute for their members. And also how you need to save for post-retirement healthcare, just to access to healthcare for the age, to also to address the need for healthcare cover at retirement. Also, you get to enjoy tax advantages, as mentioned, 15,000 per month. So you get to enjoy that as a benefit, and also improve the standard of living at retirement. You get to enjoy a medical cover without affecting your monthly pension or liquidity. And also, just to the key takeaways, just we need to plan for your retirement with intention. We need to be mindful of our future needs. Also, we need to start early. Like now, this is the time to make a difference. And also, to as time goes by, it's also we usually say unajita kamkutano. You just review your plan on how you're progressing to the retirement to your retirement journey. Because we usually say every day you wake up, sometimes it's either you're closer to retirement or you're close to death. So, and sometimes retirement comes early. So just know every day you wake up, you're closer to retirement. And maybe as I wrap up, maybe take back to Vincent, just we need to ask ourselves this morning: are we ready for retirement? How much money will I require? How long do I have until retirement? How will I access my retirement savings? How big is my fund? How long will it last? How will I cater for my health? Will a pension cover me adequately? And we are here for you to assist you to answer those questions. And just to mention is that we need to plan for now, plan for later, plan for life. And back to you, Vincent, and thank you, members, for listening to me. Thank you.
Very much, Martin. That was illuminating. So as I finish off, maybe I'll want to finish off with the takeaways from today's session, and then give it back to Evelyn for the Q&A session. So I think our key takeaway from today's session is one. We need to plan our retirement with intention. Basically, we need to do this with intention because retirement is a reality. We are growing old. Our children are not going to take care of us. We will need to take care of ourselves when we finally reach the retirement age. We need to be mindful of our future needs. We need to be mindful of our future health needs. We need to be mindful that we will still have people to take care of today and at retirement. So we need to circle back to the first one, plan your retirement with intention. We need to start early. For those of us who have not started, today is the day to start. Even though it might not be early, still today is a good day to start. And remember to review your plan regularly. Review, adjust your course, and keep on moving, because that's the only way we will then be able to retire comfortably, and we will be able to have peace of mind at retirement. Apart from that, I would like to thank you again for attending this webinar and listening to us. Evelyn, back to you.
Thank you, Martin. Thank you, Vincent, for that practical and insightful session. You've addressed some of the queries people have. That includes the tax advantages, the flexibility, and some of the common mistakes people make before when planning for retirement. Vincent, you've highlighted that only 20% of people are actually saving for retirement. So that means the 80% of us are actually not preparing for retirement. And I'll give you a famous quote that says, the best time to plant a tree was 20 years ago, and the second best time to do it is now. So dear customers, our dear members, it's not too late to plan for retirement. And without much further ado, we will go to the Q&A session. Some of the questions have been addressed, but a few of them, we handpicked a few of them. So Vincent and Martin, prepare yourself. So first question on PRMF. Can both employers and employees contribute to the PRMF, and how does that work in practical? Allow me to read 2 or 3 and then you can proceed. And then, can an individual opt out of NSSF Tier 2 contributions? Martin as well. The third one on retirement options. Between annuities and IDD, which type of retiree is each option best suited for? Vincent or Martin, please proceed to respond. Then we can go to the general questions.
Thank you, Eve. I'll first start with the question in regards to the retirement options, which retiree best suited for when it comes to an annuity or an income drawdown. Just to mention is that what happens is that depending on how much you have, it also guides on which retirement option you're able to purchase. Because, for example, if, for example, you have, let's say, usually say for income drawdown, at least have a minimum of at least 5 million, so that at least you're able to get, let's say, to take advantage of, let's say, the returns and such, because at least you're able to, let's say, to vary depending on the market performance. As I had mentioned earlier, is that you can draw down based on the market performance. But if, for example, you have 2 million, I wouldn't advise you take. Yes, it's still a choice as a member, but I wouldn't advise for you to take an income drawdown, because if, for example, you have 2 million, for example, the market performance, how the rates are, they keep on fluctuating every year and such, it might also affect on the future drawdown, because you might find after 10 years in an income drawdown, you have nothing, and that time you're at the age of 70, and that's when you need more money. But in an annuity, you're guaranteed that, yes, as long as you say if you have 2 million, that is around 20,000 per month, you're guaranteed of 20,000 even at the age of 80 and 90. You don't have to worry about market performance. Because sometimes even at the age of 75, and you're worrying about maybe what would be my monthly pension. Because in an income drawdown also, it affects also the budgeting, because you're not sure of how much you'll be getting next year. So also, for example, let's say this year, maybe based on the budget, the monthly budget was around 50,000. Next year, you get an income of, let's say, 40,000 because it's based on the closing balance at the end of the year. Then you get 40,000. Then you have to adjust your lifestyle every now and then, compared because of the market performance and because also of the balance that you had at the beginning of the year. But in an annuity, you're guaranteed at least, if it's 30,000, able to plan for 30,000 for the next maybe 30 or 40 years. So at least it's that peace of mind. So, but you can take both. If you have, for example, as I mentioned, you have 10 million, you can take 5 million and an annuity, 5 million income drawdown. The advantage of income drawdown is that after 10 years, you can pull out if you have the balance at the 10th year. Then there was another question for, can an individual opt out to the NSSF contributions? Yes, you can opt out, as long as the NSSF Act mentioned is that as long as you are as long as an employee is registered and the person they're contributing is of the age of 18 years and above, they're required to do statutory deductions. That is SHA, there's housing levy, and there's NSSF. That means in NSSF there's both tier 1 and tier 2. So just to advise is that even you as an employee, you can initiate that conversation with your employer. Then you can mention is that I would like my NSSF, instead of going to NSSF, it can the tier 2 can come to CIC. Then you get ease of accessibility at retirement. And maybe just to mention is that contracting out to CIC doesn't mean that you can access your benefits if you're below 50 years. The same law applies, is that the benefit you get to enjoy is the ease of accessibility at retirement, the good returns that we declare. You're able to monitor your contributions through digital platforms, but access is at retirement. You can only access it, for example, there's ill health, if you're below 50, there's immigration, you've gone to another country, death you pay to the next of kin, and permanent disability, where you have been proven that you cannot continue working, you're able to pay 100% if you're below 50 years. But for accessibility, because sometimes you have seen cases that people, they are like, let me contract out so that at least in case I leave my employer, I'm able to access. No, we still follow the same law. It's only that you get to enjoy those benefits that I mentioned. The other question is that how does post-retirement medical fund works? So it's not a must for the employer to contribute for you, but as an individual, you usually say it's a responsibility to take care of your retirement. Because at the end of the day, for example, there's an self-employee and employee who gets to enjoy those benefits. It's you as an employee. So what we encourage is that you can, as a person, you can take advantage because there's a tax benefit of 15,000 per month. Take advantage of it. You don't have to do 15,000 because sometimes with the cost of living and such, it may be a stretch. Even do just 1,000 shillings under PRMF. Then you also have involuntary contributions. Then you also the NSSF. That one is enough. But as time goes by, maybe there's a salary increment. Don't increase your expenses. Just increase your saving. Just balance your saving, expenditure, and saving, so that at least when you retire comfortably. But sometimes you find there are also employers who say, if you do this contribution of 2,000, I'll be able to match up to this level. So it can be a conversation, and maybe in case you want to further this conversation, you can reach out to us. We'll provide our email addresses so that we're able to discuss this matter further. Thank you.
Thank you, Martin. To the general questions, Mr. Vincent, prepare yourself. So there's one question here that says, in the informal sector, what options do you have for retirement? And the second question is, for someone earning a steady income, how should they balance NSSF Tier 2 and individual pension contributions? Vincent, over to you.
You've come again with the second question.
For someone earning a steady income, how should they balance NSSF Tier 2 contributions and individual pension contributions?
Okay. All right, thank you. I think I'll answer the two questions. So for someone in the informal sector, what options do we have? If I'd like to mention to this person that CIC runs a personal retirement scheme, which we call CIC scheme, that is specifically registered and built for individuals to be able to save for their retirement. They can register online on our portal, cicpension.co.ke, and they can be able to make their contributions there on a regular basis as and when they are capable of. Contributions start with a minimum contribution of 500 shillings. The scheme has close to 20,000 employees, 20,000 members, sorry. And all these members are made up from all sectors, employed, people from informal, and they make contributions as and when they are capable of. For someone with a steady income, how should they balance between personal retirement scheme contributions and NSSF Tier 2? Of course, as Martin alluded earlier, that the NSSF Tier 2 contributions are capped, and they are already defined to be at 6% of someone's pay, up to a certain threshold. Of course, what you can do, and what we like to encourage people to do, is you need to look at your budget and how much does it allow. And normally, we always say that you need to be able to pay yourself with at least 20% of your income. Basically, put 20% away into contractual investments, retirement benefit scheme being one of them. So you are remitting 6% to under the NSSF Tier 1 and Tier 2 contribution. And you can do the rest you can do maybe another 6 or 7% into a retirement scheme, and then the rest into other contractual investment. And as a result, you will be able to retire well. Thank you.
Thank you so much, Vincent. I think there's just one more question. This one I will let Martin answer. Can you share the income drawdown calculator or the annuity calculator? Martin, over to you.
Thank you, Eve, for that question. I don't know whether, let me share back my presentation. This is just to show how an annuity looks like, and also an income drawdown. This is just how the calculation looks like. This is a person who was earning, who had saved and had 5 million at the time of retirement. And this is just to show you how much a person is able to get. This just to give you an idea of the expected maybe monthly pension at retirement. And maybe it's just an assignment maybe that I'll also give to you, is that just go back and check your statement and see how much you have accumulated. If, for example, you have not saved, then you need, what you need to do is that you need to ask yourself, if, for example, I need a pension of 100,000, how much do I need to save per month so that I can be able to achieve maybe 10 million, so that I can have a monthly pension of 100,000? Because if, for example, on average, if you have 10 million, the monthly pension is around 100,000. Just do 1% of your saving. So in a same case on an income drawdown, what happens is that if you have 5 million, just do 12% of 5 million. It tells you how much you'll be getting per month. Because if it's 12% of 5 million, that is 600,000. You divide by 12, that's around 50,000 per month. But for income drawdown, it will vary, because now year two, come let's say next year, it will be the closing balance as of that 1st December that will get on the monthly pension that will get in year two. Same case that will happen in year three. And that's why you are mentioning, we are recommending that you draw down based on the market performance. But for an annuity, it makes it easier. It's because what will determine is what you have saved. So in short, just to mention is that if you need a 60,000 monthly pension, you need to have saved 6 million. If you need 10 million, you need to have saved 10 million if you want 100,000 per month. And maybe just to mention is that sometimes you don't have, it's not a must you save in a pension scheme, because sometimes, because what you need to do is just to ensure, if you need 100,000 per month, just have investment that will give you 100,000 per month. You may be getting a monthly pension 50,000, and maybe you have rental income for an additional 50,000, or maybe you're doing farming, you're getting maybe an additional 20,000. You just need to balance. You can diversify. Sometimes people say you don't put everything into one pot. You can diversify, but no, it's now for you to be able to do that assessment. Whatever investment that I've done, are they able to give me 100,000? If I've saved 5 million, I'm getting 50,000. If I have rentals, are they giving me maybe an additional 30,000? If I have maybe the farming that I'm doing, is it able to give me 20,000 per month? Then at least you have 100,000. So it's not about just saving for retirement. Doesn't have to be saving in a pension scheme. You can do a portion in pension scheme. You can do other investment, but just to ensure, for what we are trying to tell you is that you need to evaluate how much do you need per month. And usually say, even as I conclude, is that, for example, the income replacement ratio. If, for example, you're earning a salary of 100,000, when you retire, at least you should have around 75,000 per month. But the question is, if the 100,000 that you're getting now is not enough, how much do you need to do? And that's the conversation that we need to have, is that how can CIC able to support you so that you're able to realize that dream of retirement, of getting a pension of maybe 100,000, 200,000? And then that's the conversation we should have. How much do you need to do per month through either voluntary contribution, if through PRMF, if it's an SSF, is it enough to take care of you at retirement? So we're able to guide you, and we have tools that are able to support you to be able to do projections, so that at least you don't have to worry. Maybe you have 5 years to retirement, then you're like, I only have 5 years, and my payslip is depressed. How else can I do? We're able to work. It's a journey, so we're able to work with you now from today going forward. Thank you.
Thank you, Martin. I have one final question from an anonymous attendee. Mr. Vincent, this is for you. If I have taken an annuity with an insurance firm and down the line the firm collapses, what happens to the annuitant, or rather what safeguards has the regulator put in place so that the annuitant does not slide to poverty or get stressed to death? Vincent, over to you. Vincent?
Thank you. If so, in the Insurance Act, we have what we call protected, funds, and annuities and retirement benefits fall under that. And what will happen is that the regulator, of course, there will be a time that the annuitant will, take a bit of a hit because of a delay in payment, because that current underwriter will not be working. However, much later, the annuity will kick off, and what will happen is that the regulator will be able to offset these annuities to another solid underwriter who will then pick up the pieces and be able to continue servicing that annuity. Yeah, so I think that's what will happen in the interim. Yeah.
All right, thank you, Vincent. As we come to the end of today's session, I'd like to thank our speakers, Vincent and Martin, for sharing your expertise. To our audience, thank you for participating in this session. And if there's one takeaway from today, it is this. Retirement planning does not have to be complicated. It just needs to be very intentional. So we've shared our contacts in the chat box. Please reach out to myself, to Vincent Ochoi, or to Martin Mwangi. Thank you and do have a lovely day.